Good evening, everyone. So I'm Viswanadh. I'm the founder CEO of Simplify. We are into supply chain finance, into digital lending space for the past 5 years, and we have been navigating and propelling towards becoming a new gen, futuristic fintech unicorn. So our experiences as a fintech, and this is quite an important topic which I'm happy that I'm actually moderating, parameters that we actually are, or lending type, 22% CAGR, it's the most growing, segment, right? So when such a rapid pace, the growth is happening, we also see the regulatory is one of the important aspects. I was actually discussing with the August panel, and then we realized that it comes on the top of the pyramid, right? So, from Digital Lending Association, you have evolved multiple regulatory frameworks. So, what do you see this evolution? How do you see this evolution shaping up? And I think so. There's a new framework, which is the ICES, which you have launched. Maybe if you could actually explain that, it would be a good start for the panel.
No, thank you so much, and I hope I'm audible right now. So, well, when we look at the across digital lending ecosystem in this country and fintech ecosystem which is there are close to over 10,000 fintech firms in this country. Digital Lenders Association of India has top 100 plus lenders in this country with us. There are very few large players, then there are middle-sized players, and there is a very long tail of fintech players in this country. So this is how it is spanned up as far as fintech is concerned. Now, this entire sector is very diversified in terms of their legal forms, their product offerings, and the regulatory regimes which are there. There are NBFCs, all of us know banks, NBFCs, and then there is another segment of firms which we call loan service providers or LSPs, and they play a significant part in taking financial access or digital lending to the end customers. So I'm setting up this context so that we know what we are talking about and in which, where we are operating as far as regulations are concerned. So regulated entities already regulated by Reserve Bank of India. LSPs are not directly regulated, but they are regulated through their partner entities, which are regulated entities, like a bank and a LSP, just like a bank and a business correspondent. So they are also, regulated indirectly, and they're allowed to work in this country. Because I'm clarifying this because there's a lot of talk around unauthorized lending apps and fictitious, websites and, shady players. So those are different guys. So let's make it clear. As far as regulation is concerned, I think what we have seen, and we are very thankful to Reserve Bank of India and Government of India, Prime Minister Modi, and the initiatives which are there for coming up with a more proactive and a self-regulatory regime of regulation in this country. So you might have, most of you must have, probably you have seen the SRO discussion which is going on for last few months now, more vigorously, although it was there in RBI thought process, there are different recommendations, working groups, but now there is, the latest news is this: RBI has already released a draft framework for recommendations for SRO-FT from different stakeholders. And by the way, an SRO is a non-governmental third-party organization which kind of, facilitates a self-regulatory regime. Usually, industry associations and their members come together on the basis of a consensus-based approach. They form some rules. And just like that, DLAI also has a code of conduct. You mean a code of, rules. And then from regulatory side, there is something called digital lending guidelines, DLGs, and different guidelines. So overarching, the RBI is there, and then there is a self-regulatory organization, then there's a consensus-based approach. And as far as
you've been hearing a lot of news, right? I mean, some big players, great fintechs, unicorns, actually are now coming under the lens, and they were asked to actually shut down some of the practices that they were actually doing, right? You have been in the risk world, you have been in the assessment, credit assessment world, and you are actually leading some of the financial services now. So what is your take on it? Like, is it the regulatory versus innovation?
Step back and say, India is blessed with a very forward-looking regulator when it comes to the credit markets, right? RBI is, of course, very, very active. I'd say hyperactive of late. But that's also because typically we've seen innovation outpace regulation, right? And regulation is now doing the catch-up game.
That's great. Actually, you've been the first and the fastest digital lending startups, and now it's a scale-up, or maybe I would actually say it's a big company, right? So, explain your journey from being an early salary company to 5. What's your journey?
Right, and that was a very interesting part. We said we have no prepayment penalties on the product. Till now, I think there's no other banking product in the market unsecured which have a feature like this. And that's what caused a very interesting result, that our consumers always said that when I need money, I take, when I don't money, I give it back. Now that was a starting pillar. The second pillar was
how do we actually build that sustainability, right? And of course, disbursements are great, but collections is one more bigger problem. So, we could actually have disbursed 1,000 and then the collections would be lining up with just, there's a lot of delinquency out there. So PayU has been in the journey from quite a long time, right? And I think so they are one of the early in terms of the raise of payments. So how are you shaping the digital lending, scenario in India?
You all know that the 10-second PL, the HDFC Bank, the one starter who started this revolution. Later on, all the banking, whether ICICI Bank, everyone followed the HDFC, this narrative. Whether you required or loan or not, we have given the eligibility on the customer's net banking, as and when the customer required, they can avail that loan. So whatever the underwriting checks we have done, basis the customer transaction, everything, and we have a payout, we have a connected banking. So where we helping out our enterprise clients. B, the collection part. Now, in the first part also, when we disbursing that money, so in disbursement also, not only the metros also, into semi-urban, tier 2, tier 3 cities also, what kind of we have a QR solution, we have a someone going on a manual person collecting, and everything we have built on. If I talk about the collection mechanism, the collection is a very tedious process, because even in a tier 2, tier city, someone has to go personally and collect that money. So how PayU and other aggregators come up with this idea?